Adobe is one of the most contested stocks in the whole investment world right now. Adobe stock has been an absolute stinker. It's down 19% year to date, down 25% over the past year, and down almost 20% in the past 5 years. Meanwhile, the S&P 500 keeps reaching new highs and has increased by 110% in the same time period of 5 years. And that's without dividends. Oof. So, if you've been a shareholder of Adobe in the previous 5 years, I'm so sorry for your loss. But here's the interesting part: Adobe's business hasn't fallen apart in the previous 5 years. In fact, revenue is going up consistently year after year. If we look at free cash flow per share, which is the true indicator of a stock's value, it's also up since 2021. Not by much, but it's still up. And the long-term trend seems to be intact. There's no two ways around it. Adobe is operationally a better company today than it was 4 years ago in 2021. So why is this stock in the doghouse? Well, it's simple. 2 words: multiple compression. In 2021, investors were paying 56 times the free cash flow in order to buy a share of Adobe. Today, that number has fallen to 20 times free cash flow. Investors in 2021 were paying nosebleed prices for each dollar of future free cash flow, and now they're not. Expectations have been reset, confidence has been cracked, and the stock price is as you see it on the chart. You get a 50% compression in the multiple, and you get a 50% compression in the price. Like Warren Buffett said, in the long term, the stock market is a weighing machine. In this video, I'm going to break down exactly why the sentiment has shifted on Adobe. We're going to talk about the product, the pricing, AI, competition, and trying to filter out what is real and what is narrative. And then we'll run Adobe through the RatedA framework to answer the only question that matters. Is this a company that's worth owning for the long term? And if so, at what price? Let's dive right in. The descent to the abyss for Adobe started when ChatGPT and other image generation models first came out in 2021, 2022. Soon thereafter, people started to realize that it was only a matter of time until AI models became good enough to really challenge Adobe's dominance. I mean, if anyone can just develop really crisp, really beautiful images just by talking into a phone and describing what they want, then who needs Adobe's complex suite of video editors and image editors that take many years to master? It takes a lot of time and a lot of experience to really get good at using Adobe's products. And even when you do know how to use them, it takes a lot of time and a lot of effort to generate an image of this quality. Well, with these new AI models, you just describe what you want and get it instantaneously. So that's the first big cloud hanging over Adobe's head. The defenders of Adobe will say that these image generation models will only take users from the low end of the design spectrum. People like newbies, people that just edit images for fun, for example. And I tend to agree with that view, but this is still potentially a crack in Adobe's moat. The second big cloud over Adobe's head is that competition is heating up like never before. Adobe is a very old company, and they've been dominating the creative space for decades. If you work in a professional creative team making films or photography or any other type of digital asset, chances are that you and your entire team are using the Adobe suite. But there are now competitors that are coming up the ranks. The first being none other than Canva. Now, you've definitely heard about Canva at this point. They're making a lot of noise in the creative industry. And originally, they were created for beginners because they're so easy to use. But slowly and surely, Canva is expanding its offering, both organically and through acquisitions. Now, because Canva made its name by being appealing to beginners in the past 5, 10 years, when those beginners grow up and graduate and start going out into the professional world, they take Canva with them. In a way, Canva is growing up with them. And these people, when they get to their professional workspace, they're likely to promote Canva and become advocates for Canva in the workplace. And then there's Figma. Now, the fact that Adobe was willing to pay $20 billion for a company that was making $200 million in sales back in 2022 for this little company should tell you everything you need to know about Figma and the hype around this company. Figma was always created for professionals from the very beginning. Their bread and butter has always been UX and UI developers. And its secret weapon is that it's designed first and foremost as a collaborative tool, something that Adobe clearly isn't. And already that's appealing to many teams in the professional world. Figma's founder is a very ambitious man, and he's been directing his company into new verticals, creating a suite of products that's very similar to Adobe's and embedding AI into everything that he puts out into the market. And as you would expect in the competitive market, Figma is currently trying to do everything it can to move teams over from Adobe to Figma. The third big cloud over Adobe's head is that professionals don't really like Adobe. Sure, they use Adobe because they have to, because they have no other option, but they wish they could switch to another app. That's because Adobe has somewhat flexed its muscle in recent years by hiking up the price, for example, despite innovating less than competitors, but also by introducing controversial terms and services. Here's an article by the Marketing AI Institute. All you need to read is this passage here. The controversy began when Adobe updated its terms of service and required users to agree to give the company access to their content via automated and manual methods in order to keep using its software. So Adobe was going up to creators and telling them, hey, give me access to all the things you create. That way I can train my AI on that. Obviously, as a creator, this would make me angry too, especially if I'm not compensated for that. So Adobe's moat is clearly being assaulted from multiple angles. Because yes, this is really a moat problem. This is not a profitability issue. The company's super profitable, margins look good, revenues are still growing, and so is free cash flow per share. So profitability looks stellar. And when it comes to safety, well, this is a pretty stable industry. You look at Adobe's revenues and they're up and to the right, always about 10%. And the creative field is one that's growing really quickly and really steadily at the moment. But when it comes to the moat, Adobe still has some key strengths. I'm just going to skim over a few of them right now, but if you want the full in-depth detail, they're written out in a report on the RatedA database. You can access them over there. Of course, the first moat is that Adobe has many products and it's deeply integrated into enterprise workflows. It's really difficult to rip out Adobe and replace it with a competitor because there are so many digital assets that are already living on Adobe and years of experience that it's really complicated to switch. Another strong point for Adobe is that the suite of Adobe products is really technical. It's really difficult to learn and to use. But it's also the standard in the industry. So when you go to a university where they teach graphic design, for example, they will probably be teaching the students how to use Adobe. And then the students take this experience and bring it with them in the professional world because that's what professionals use. And then workplaces hire people that know how to use Adobe because that's what they use. And so universities keep teaching Adobe. You see how the cycle just repeats and repeats. And let's be honest here. If you spend 4 or 5 years of your life trying to master a complicated tool like Adobe, how likely are you really to switch to a different tool in the future? Not really, I would say. Strength number 3 is that Adobe is the standard in the creative industry. Much like Excel in the finance world, everybody uses Excel because everybody uses Excel. It's the same for Adobe. In the creative industry, everybody uses Adobe because everybody uses Adobe. And finally, the last big strength that I see for Adobe is that it's the incumbent. It already has a massive installed base of millions and millions of creators and enterprises. Which means that as soon as Adobe wants to release a new product, for example, the new AI innovations that it's bringing to market, it can release them and test them with millions of users almost instantaneously. And that's a really big advantage that other Adobe competitors that are smaller simply don't have. Now you kind of get an idea of why the moat rating for Adobe is a 3 out of 5, which is slightly above average. Adobe does have competitors that are nibbling at its heels, which is lowering the moat score overall. But if you zoom out and look at the really big picture, it's clear that Adobe still has a stranglehold on this creative industry. The quality rating here answers the question of whether we want to own this stock or not in the RatedA model portfolio. The answer is yes. Any company that's rated as an A or a B is of high quality enough to be owned in a long-term portfolio. But at what the value rating here indicates that Adobe is close to the buy range where it becomes a good buy in order to get outperformance over the next 5 years. So what we're going to do is we're going to use the fair value calculator and see what type of assumptions we need to plug in order to get that market beating returns. Here are my big assumptions for this model. 10% revenue growth over the next 5 years. Adobe doesn't pay a dividend. They return capital to shareholders via buybacks, so I'm assuming a lot of buybacks, from 440 million shares today to 400 million in 5 years. I'm also assuming a terminal multiple of 25. And with these numbers, we get a total shareholder return of 16, which is market beating, when you buy the company for $330. If we turn that terminal multiple to 20, which is what Adobe is trading at today, then you get a total shareholder return of 11, which of course isn't as good. If you want to buy Adobe today at a price of $360 and still beat the market with a return of 15% per year over the next 5 years, then Adobe needs to hit 11% in revenue growth over the next 5 years and a terminal multiple of 25. If you think that's doable, then Adobe is probably a good buy here. But I trust my value ratings and I would wait Adobe to fall just a little bit in order to get into the buy range. That's it for this video and I'll see you in the next one.